Hello, everybody. Welcome back to Beer and Money. My name is Ryan Burklow.
And I'm Alex Collins.
And the reason Alex has got his belly laugh going is we both just started talking about how we normally have a beer for the episode. And it's 10 a.m. in the morning. We had to kind of change our normal time of doing this. And while we both enjoy beer, we don't enjoy it that much. So,
well, it's 5 o'clock somewhere. It is not 5 o'clock here.
Correct. So no beverages for today, but we do have a great topic today, which is net rate of return. Specifically, what is your net rate of return? And I think this is, we did a net after tax rate of return episode. So this is not that. This is more of how is your money really working for you when it takes into consideration inflation?
Right.
And so we're going to talk about that. And then we're going to talk about, okay, how do we combat that, right? Like, how do we actually build a portfolio or a balance sheet to make sure that not only are we keeping up with inflation, but, maybe somehow beating it so that our money can grow. So that's today's episode.
And as we haven't talked about this, but Ryan, I'm envisioning this going into the next episode about allocation and how allocation changed from a three-legged stool to a two-legged stool, and how like you and I have only ever known the two-legged stool.
Yep.
And having a conversation around that for our next podcast episode.
Funny you mentioned that because that is the exact episode that I've already got on that. So you knew
Perfect.
Exactly where I was going with this. So let's dive into it. Let's define a real rate of return versus what we'll call a nominal. And I didn't want to use that terminology mainly because I think it's, we like to confuse people in our industry. So let's keep it very simple.
Finance is almost like I've heard a lot of people use refer to like our conversations as, oh, you're speaking in finances as though it's a foreign language.
Yep.
And when we use the term nominal, a lot of people don't necessarily understand that. When we say nominal rate of return, what we mean is what's the pure rate of return. When we say real rate of return, what we're talking about is what is your spending power. And so if your nominal rate of return is 10% and there's a 3% inflation factor, the formula is a little bit more complex than this. However, at a base level, you subtract the 3% inflation from the 10% rate of return, and your real rate of return was 7. And it's important to take this into account, especially since we've gone through a relatively recent high inflationary period, and that has eroded real rates of return.
Yep.
We've also gone through a decent amount of volatility recently. And so returns are kind of bouncing here, there, and everywhere.
Yeah. So it's important to understand this because, again, I think a lot of times if you get a 3% rate of return, well, congrats, you just kept pace with inflation, right? Your money,
historically speaking,
correct. If we're using that 3% figure. So what Alex just mentioned was like a 10% figure. Like a lot of people will, you hear all the stats around there. Well, the S&P 500 is averaged, right? And so we kind of threw out a 10% figure for that, for stock type of equity type of part in the portfolio. Whereas bonds, right? If the bonds are getting a 5% return, nominal, that is, like not considering inflation in this, take out inflation, and now bonds are only getting 2%. Oh, and we didn't take into consideration taxes yet, right? So like, I know we're getting into the weeds in the last couple of episodes, because if you really add in taxes to these numbers, like they're not exactly what you think you're truly getting, which is why it's really important to understand. It's not like rate of return is important.
For sure.
And what is just as important, and frankly, I might argue more important, is the location of your money and the strategy of why you're putting it there, with the implications of pulling the money out. Because in the end, we're all saving this money to eventually distribute to someone, either ourselves or legacy purposes.
Yeah. Like when we actually think about it, there's really 5 different areas that we need to take into account. And yes, the rate of return matters. And a lot of the other factors, especially when combined, will be a much bigger impact than rate of return.
So now that we've taken this into consideration, the real rate of return, now what should people do about it, Alex? Right? So okay, now I'm getting a real rate of return of 6 or 4, depending on your allocation, what risk profile you've got. What should people do?
Well, so this then goes back to a conversation that we had recently where we're talking about market based versus promise based assets. I believe that was episode 248, Ryan.
Yeah, that was episode 248. Definitely check that out because that definitely plays into this conversation. We're not going to go into the weeds too much about that.
But the basic idea and concept was if we shift the some of the market based assets to promise based assets, and if we're able to get a similar rate of return to our bond portfolio, then what we're able to do is basically take some risk off the table. And when we take a look at our allocation, this allows us to become more aggressive with the remaining market based assets and have the same or even potentially lower risk overall because of the existence of the promise based assets. And so now, instead of having a 60% equities, 40% fixed income, because we've shifted some of the portfolio over to a promise based asset, we can take more risk in the market based assets and have maybe an 80% equity position and a 20% fixed income position. And that allows us to then get a better, both nominal and real rate of return whilst taking the same, if not less risk, depending upon the rest of the portfolio and what we're ultimately trying to accomplish.
Too often, and we spoke about this in the last episode, but I want to make sure we hit this one home. Too often, we see people when they're doing their risk profile, it's all in individual accounts. Like this account, I'm in a 60-40 allocation or 70-30 or 80-20, whatever it is. And the top number being the equities or stocks and the bottom number being bonds or fixed income, right? Those are used interchangeably, really to mean the same thing.
Sometimes they are, sometimes they aren't.
Right. In this conversation, we're let's just say it's the same thing. But what's interesting about that, so that's that individual account. What's your entire balance sheet look like? Right?
Right.
Because in the end, that's what really matters. And so if your balance sheet is set up appropriately, and to your point, we've got guaranteed assets sitting on there, we've got plenty of liquidity sitting on the balance sheet, that might, depending on your risk appetite, obviously, that might enable you to have more stocks in the portfolio because when you do have a down year, your balance sheet is solid enough that you don't ever have to touch the stocks when they're down.
Right. And we talked about this there was an episode that we entitled The Rate of Return of Cash. And having cash liquid on the balance sheet in whatever form. And there's like, people are oftentimes like, what do you mean multiple different forms of cash? Cash is cash. Well, it's like, yes. And there's still 3 or 4 different places that we can have cash wind up showing up on the balance sheet and have it be functionally liquid. But the existence of that means that we don't have to have, like, especially during our accumulation phase, if we've got liquid cash that we can go ahead and access, well, then we're less reliant upon having a stable portfolio, which is the entire point and purpose of having bonds in the portfolio, is to create a more stable return. And if we've already accomplished that through larger allocation decisions and larger location of our money decisions, well, then we can afford to take a little bit more risk as long as we have the appropriate appetite for it. And we've looked at it through not just how is this account allocated, but how is our balance sheet allocated? That's going to have a much bigger impact on what we wind up with in terms of an overall rate of return. And so while yes, rate of return matters, some of the location and some of these other components will actually free us up to be able to go have a bigger allocation towards equities and get a better rate of return long term as a result of that.
And I think I just want to throw this out there because I'm put myself in a younger person's shoes, and they might be thinking, well, I want higher risk. I've got a long time horizon before I quote unquote need to retire. And what they're sitting with is they might have like a 90-10 portfolio, 90% in stocks and 10% in bonds. And they're considering that 10% in the bond. And no matter what person, even if it's a 50-50, like that bond component, people often think of it as a safe asset.
Mm-hmm.
It's a safer asset than stocks. But depending on your definition of safe, it may not be safe, because if you looked at, I don't know, the year 2022, bonds were down quite a bit.
What, 15% ish,
So
depending upon
bonds,
what
yeah,
type of bond you're looking at.
and bonds do go down. I mean, just take the Silicon Valley Bank, issue that occurred, right? Like, so I think people forgot that.
Right.
And unfortunately, our industry, the way oftentimes we talk is we actually talk like bonds are safe. And that's not, and they're safer than stocks. It doesn't mean that they're safe as in they never go down.
Well, and this is one of the reasons why, like when we talk about bond allocations and how we position that portion of the portfolio, we typically look at shorter duration, higher quality bonds, because when we look at bonds as a whole, shorter duration, shorter maturity, higher quality are safer within the bond space. If you're chasing high yield and long maturities, long durations, then like you might wind up with almost the same volatility as an equity position, but without the same upside potential. And so it's really critical that we take a look and understand why and how we're creating the portfolios that we are. And it's not one size fits all. There's a lot of difference and nuance beyond glossing over, oh yeah, this is a 60% equity and 40% fixed income portfolio. Okay, how do we have that allocated, and what is it that we're truly trying to do? Most of the time, the fixed income portion of the portfolio is there to create stability, not necessarily chase rate of return. And when we start chasing rate of return in our fixed income, we can potentially get in trouble. It's not saying that we don't want to ever chase it, but we need to be aware and comfortable with what we're trying to do and how we're trying to do it.
So we've kind of gone down this rabbit hole talking about fixed income and balance sheet allocation. The whole point where we started was what's your real rate of return and how to combat inflation and setting yourself up to beat it as best you possibly can with the risk profile that you want. That's the takeaway from today, which takes us to the question of the day, Alex, which we didn't talk about.
Our question today is, do you even know what your real rate of return has been? If the answer is yes, great. What's your way? How is it that you look at it? And if you're not sure how to calculate it, or you want some ways to go ahead and take a look at this across multiple different accounts and things of that nature, head on over to beerandmoney.net and drop us a line with either, hey, here's how I do it, or how do I do it? And we'll happily reach back out to you.
We say this at the end of every episode. We started this podcast to be a resource to help you think differently about your money so that you can not stress about it and actually spend time with your family and not have those worries and be present. If you found any value out of this, share it with your friends, share it with your coworkers, share it with family members. Because my guess is normally, at least with me, when I find something valuable, most of my friends actually find it valuable. Well, most of them do. Alex is a different story. Being funny there.
Sometimes I find what you say valuable.
So we hope this episode was valuable for you. And as always, Mr. Collins,
since I don't have a beer today, cheersing you with coffee, my friend.
Can't beat that.